Ticker symbol QYLD, or the Nasdaq 100 Covered Call ETF, has been an ETF that I've been holding onto for several years now, and not in a small fashion whatsoever. I currently have around 2,700 shares of QYLD across my portfolios combined, and like I said, I've been holding these shares and building up this position for several years. But in this video, we're going to go over 5 specific reasons on why I personally think that the QYLD, the Nasdaq 100 Covered Call ETF, actually might not be a good investment whatsoever when it comes to building out a passive income machine, especially if you're like me and you want to build out positions in your portfolio that pay you significant growing dividend income long term. So if you want to see an unbiased look into why I think QYLD might not be the best passive income machine for your portfolio, make sure to stick around, drop a like down below, and let's get right into it. Real quick, for those that haven't already, make sure to go to the first link in my description and grab my new dividend investing ebook, where I share exactly how I went from $0 invested to now earning over $6,000 on a monthly basis and over $1 million invested in the market. Along with the ebook, you're also going to receive my custom dividend tracker, where you can track your dividend progress on an ongoing basis and reach your dividend investing goals. So make sure to grab yourself a copy of my dividend investing ebook and the new dividend tracker today. It's the first link in my description. Now, like I shared in the intro, I personally do have quite a bit of QYLD, so you might be asking, well, if you don't like it, if you don't think it's a good passive income machine for your portfolio, then why are you still holding on to it? Now, the reason I'm still holding on to my QYLD specifically as of right now is just because I was able to lower my cost basis over time to a point to where I'm almost break even, and I definitely am looking to trim some of my QYLD, most likely in the future. Not to mention another side note, I don't think this is the worst investment opportunity across the entire market. I just think there's much better options these days, which we're going to go over here in a second. Now, the first reason on why I think QYLD might not be the best option for a long-term income generating ETF in your portfolio is, for one, the total expense ratio is 0.61%. Now, I get it, QYLD isn't going to have a 0.06% expense ratio like that of SCHD or some of the other low-cost index funds, but I do think that 0.61%, especially for the fact that QYLD's management isn't writing like daily or weekly cover calls in this ETF, it's pretty much set it and forget it for the most part. This is definitely a pricey expense ratio considering what you're getting, in my opinion. And I get it, the more income-focused crowd is sort of jaded towards those higher expense ratios these days. But again, for what this ETF really does, for what the management does, I think that's pretty expensive, especially as you get more and more shares, it can add up. Now, the next reason I think QYLD might not be a good passive income generating option for your portfolio is simply because the passive income, if you will, has gotten smaller and smaller over time from this ETF. Now, looking at the historical payouts every single month since inception, for the most part, this ETF has paid more or less the same, around 18 cents on average maybe, with some years and some time frames paying upwards of a quarter on a monthly basis, which is massive. But over the last few years or so now, we would honestly be lucky to get a 20-cent distribution paid to us, with some months being as low as 15, 16 cents, and recent months being as high as around 18 cents. So again, nothing insanely horrible, which is again why I'm not selling off or flash selling my shares that I currently own, but still over time the distributions have been smaller, and who knows, will the distributions continue to be smaller in the future? I guess that's going to depend on how much volatility is in the market and how the market trades, but because of this ETF strategy and because the mechanisms at place, there's a good chance that this ETF is not going to pay any sort of big distributions ongoingly. Now, I get that any dividend ETF or dividend paying stock can change the dividends or distributions over time. They can get smaller or bigger. And because of this ETF strategy, I don't necessarily think that we're ever going to see dividend growth. But over time, the distributions have not only been smaller, but smaller by a large portion, at least comparing to the good days. Now, that brings me into my next reason being on why I don't necessarily think this is the perfect investment option for some investors out there, especially investors that want to generate cash flow and more cash flow over time. And this is simply because the dividend growth rate over multiple different time frames is actually negative when it comes to QYLD. Like I said a second ago, the distributions have been getting smaller, and with the facts that inflation is here and cost of living just keeps getting more expensive, I for the most part think it's a good idea to invest into things that are going to pay you dividends or distributions and pay you more and more over time, and not the other way around. And again, I understand this ETF is a cover call style ETF, so it's not necessarily going to pay, or they're not necessarily going to make the same amount of money off premium every single month. But just knowing that and seeing how this ETF has paid historically, there might be better options out there that are going to pay you at least a steady amount of distributions across the board every single month. And on top of that, maybe even pay you more and more slightly over time. Now, a perfect example of this in practice would be Devo, or the Amplify CWP Enhanced Dividend Income ETF, which although does not pay a massive distribution, it has paid slightly more and more over time, from 13 cents upwards of 15 and 16 cents over the last several years. So even though there's not massive dividend growth when it comes to Devo, there is a slow and steady amount of more cash flow getting paid to their holders. Now, the next reason I think QYLD might not be the best ETF to hold on to is because the ETF's price performance over time and how much this ETF has decayed in price since inception. Now, believe it or not, QYLD used to trade around $25 per share, and this was all the way back in around 2013. And since then, on the max time frame, this ETF has lost about 33% in value. Now, I get it, it's paid around 12, maybe 14% yield over certain years, so net total return might not be as bad, but still, if you want to hold on to an ETF that at least historically has dropped consistently over price every year or so, then QYLD might be a good candidate. Now, I've talked before ad nauseum why these covered call style ETFs, especially these higher yielders, tend to do this over time, so we don't need to go over that in this video. But long story short, the upside is generally capped with these style of ETFs, and the downside, although protected, is not protected enough during certain time frames. So because of that, you're not necessarily going to have any exposure to upside with an ETF that offers what QYLD offers, but the downside can get ugly like we've seen historically. Now, especially because there's so many other covered call style, income style ETFs across the market these days that don't necessarily have the same exact strategy that QYLD offers, there's better options to buy into, which again might be a reason on why QYLD might or might not be a good option for those passive income investors out there. Now, the last reason I think QYLD might not be the best ETF out there for those passive income investors looking to generate a massive amount of cash flow and total return long term is because this ETF has not necessarily done that at all. You see, over the last 10.64 years, with a $10,000 investment into QYLD and reinvesting those dividends back into more QYLD as the ETF has dropped over time, that would have turned an initial $10,000 investment into around $19,900, or a total return over the last 10.64 years of 99.11%. Now, that's on average around 6.68%, or around 4.56% without those dividends being reinvested. So no matter how you want to look at it, 4.5% or 6.68%, that's definitely trailing behind the overall markets over this time frame, especially, not to mention with all the other facts, all the other reasons included in this video. I think there's just more or less a good reason to stay away from this one, at least if you ask me. Now again, you might be saying, well, stay away from it. You said you currently own almost 3,000 shares, and that's once again simply because although this ETF has underperformed, it still is in the green, especially for a higher yielder that's offering around a 12%. It still is offering around a 7% average annual total return, which isn't horrible. Again, it's not great, but it's not horrible. But for all those reasons and more, I still think for investors out there that are looking to have exposure to high income generation on a monthly basis, that is, and want some exposure to an option strategy, there's so many other better covered call style ETFs across the market, and I talk about them all on my channel all the time. So my closing thoughts on QYLD in 2024 at least is that, once again, it's not the worst covered call style ETF across the market. I think some investors are definitely a little bit too harsh on this ETF, especially because over time, since this ETF's inception, even with the NAV decay, this ETF has still returned around 5% to 7% total return, and that's whether or not you included dividend reinvestment or not. So a 5 to 7% total return, although again underperforming and not the greatest by any means, there still has been much worse across the market in certain verticals, so we have to give QYLD a little bit of credit there. But if I could go back in time when I started buying so many shares of this one, would I have bought as many shares as I did? Absolutely not. I would have spread the money out into other different covered call style ETFs across the market, if of course I could go back. But now, most important of all, I want to hear from you guys down below. Do you currently hold any of the NASDAQ 100 covered call ETF QYLD in your portfolio? Let us know yes or no in the comments down below. If you enjoyed this video, make sure to please drop a like on it and subscribe for more future content like this. Thanks as always for stopping by, and if you are interested in investing, make sure to check out these recent videos I posted right here.